And he said by the
Mhm.
end of this, the yen's going to be at 200 or 300, which is a long way from 140 where it is today. And that's going to be a lot of volatility. So
Mhm.
again, let's maybe start talking about the end game of where the Japanese yen might actually be in a few years' time.
Sure. We can call it the Japanese yen game, which is what I've effectively coined it as, and other people have said so on Twitter. I think Brent is correct. And Wes Nakamura, another market analyst who's been covering the yen, has been saying the same thing, that, yen to 175 is actually less likely than yen 120 or yen 300. It's kind of a binary choice of outcomes, right? They can, and they've proven in the last week that they can deflate the yen. They can make sure that the yen retains its purchasing power and it falls. USD JPY falls and they can go back to 120 or 115. But the price of that is the unwind of the carry trade and the deflation of assets across their entire economy. And that's pretty concerning for the Bank of Japan, because what they've been trying to do in the last 10 years is reinvigorate their own domestic stock and bond markets. And they've been really failing on the bond front, even despite, 8+ years of yield curve control since 2016, which actually coincided with Ben Bernanke flying out to Japan, to Tokyo, to start to implement his monetary experimentalism, so that it would be ready by September 2016 for rollout. But the equity market only recently, only in April of this year, crossed 38,000, which was the high set in December of 1990, before the slow motion train crash of the lost decade of depression that Japan experienced destroyed the equity market. So Japan only recently was able to reflate this bubble. And then within, within a week, within 2 weeks, with them hiking rates and then signaling more rate hikes were coming, they completely destroyed that entire illusion that they had actually reinvigorated their own stock market, and that is anything short of a bubble. It's essentially just a massive carry trade bubble and 0% interest rate bubble. And so if they raise rates now, they're trapped. And the reason why Brent and I have both of us have talked about this at length is because, especially the yen to 200, 300 meme, is because when you have a country where they are the largest, global sovereign creditor, they are the largest global sovereign equity, foreign equity owner, so they own a ton of U.S. equities, and they're the largest funder of the carry trade, which is just borrowing in one currency to lend in another. So there's, hedge funds, family offices, private individuals, corporations who will borrow in yen, trillions and trillions of yen, and lend in USD or buy USD assets. And there's also a form of the carry trade where they reinvest those profits into their own equities, because if you can fund at zero and the equity market's going up, or at least it looks to be going up because of QE and low interest rates, you can make a positive spread. And the issue is that puts this pressure on the currency that's extremely hard to overcome. And normally a country would have pretty easy, solutions to this, right? You could raise rates, you could restrict capital accounts, you could, you know, limit trade, but those kinds of things are too harmful to the Japanese export-based economy, so they can't do that. And so really the only option has been the interventions. And as I've predicted, and as others have said, the interventions are basically useless. It's like throwing cash into a fire pit. And in many ways, they're counterproductive, especially if they start dipping into their treasury reserves. So they have about $1.1 trillion of U.S. treasuries held in forex reserves. And if they sell those U.S. treasuries, the bond prices fall, which means interest rates rise in the US, which means the difference between US rates and Japanese rates grows, which means more carry traders latch on. They borrow yen, they sell the yen for dollars, which effectively shorts the yen and increases the USD, and buy USD assets. So it inflates the US bubble here, and it deflates their currency. It makes their currency fall against the dollar. So that's why we saw yen go from 100 to 160 in the space of 2 years after the Fed started hiking. Now, again, we've seen very quickly. So the interventions can't do anything. If they dump their bonds, their U.S. treasuries, that will be counterproductive, because in the long run, they'll just increase the spread. And if they raise rates, they quickly blow up their own economy. So what do? And the answer is their hands are tied. They're trapped. They can't really do anything, which is why yen is going to go to 200 and then to 300, and why this thing has been a meme, and why it eventually will be true.
I tend to agree. Again,
Mhm.
I think like your thesis, the dollar endgame is a really interesting one. So maybe we can start picking that apart a little bit more. We've talked a lot about Japan, and the Japanese yen going to 200 or 300 is just one of these little dominoes that is going to fall as we're transitioning to the dollar endgame. But you've written the phenomenal book, The Dollar
Mhm.
Endgame: Hyperinflation is Coming, or Hyperinflation is Here. Let's actually start exploring that thesis a little bit more. And we've kind of explained what's happening in Japan, and we can start talking about how Japan fits into this US dollar endgame.
Sure, absolutely. So I would say there's actually two main components of the dollar endgame, right? One is the US's status as the world reserve currency. Because the US, holds the US reserve currency, and other countries have to use our dollar for international payments, for forex reserves, for trade receipts, for settlement, cross-border settlement. Globally, the US dollar has been dominant as, a payment and settlement mechanism. And what that has meant is that, historically, like Triffin pointed out in 1960, we have to, as the issuer of the world reserve currency, we have to export dollars, which means we have to be a net importer of goods. So that has meant that the US trade deficits have started to blow out, and we've started to export our manufacturing base to other countries, and those countries are the ones doing the manufacturing and importing their goods to the US so that we can export our dollars. Because remember, dollars and goods are just two sides of the same equation. If goods are flowing one way, dollars flow the other way. So with us being a net importer of goods, we're a net export of dollars, and all these dollars flow overseas and get built up in other countries, right? Now, what do these countries do with all these dollars? Well, again, you can use it for trade. You can use it for reserves against if your own currency debases, which, like I said, Japan has plenty of. You can invest it back into the US. And so what all these countries have done is they've, just like Japan, they've recycled their dollar surplus back into US assets. So they bought US treasuries, they bought US mortgage-backed securities, they bought US bonds, they bought US equities, they bought US real estate, and on and on and on. And what that causes is there's now a massive sword of Damocles that hangs over the global financial system, where if we lose reserve currency status and other countries quickly find a new solution, like potentially Bitcoin, all these countries would no longer have a need for US dollar assets, because they wouldn't have US dollar surpluses to store them in anyways anymore, right? So if that's the case, then we're talking about, 19, 22 trillion dollars of US assets that will be sold. And that means treasury bonds, equities, mortgage-backed securities, like I said, everything. And that would precipitate a massive rate cycle by the Fed to drop interest rates to zero, and a huge wave of QE, right? We're talking, I mean, if the Fed's going to absorb that, they're going to need to print trillions. I mean, they're going to double their balance sheet in the space of a month. Like, it would be insane. Now, that's obviously like the geopolitical, regime change shift of currencies that would have to take place to cause that. And that's obviously a very bearish scenario. The other part of the dollar endgame, which is maybe the more slow rolling version of it, is just the US debt spiral, right? For the first time last year, we had $1 trillion in total gross interest expense. This year, we're adding $1 trillion of debt every 100 and so days. I just noticed that last 2 weeks ago, we passed 35 trillion. And over the weekend, from not this last weekend, but the weekend before, in early August, in 3 days, we gained $150 billion of debt, which was the same amount of debt that we'd accumulated up until and past World War I. So in 3 days, we got more debt than the entire history of the country from 1776 to World War I. That shows you how insane that, this debt spiral is getting. And as we continue this game of inflation and high rates, all the debt on the Treasury's balance sheet is going to get refinanced, and that debt's going to get refinanced at high rates, and that means interest expense is just going to keep exploding. And eventually, they'll stop finding places to stuff it, right? They've been able to stuff it in the banks and the money market funds. They've been able to get boomers to load up on it. But eventually, you run out of space to put it, and you have to restart, QE. You have to restart a cutting cycle, which is why, in my opinion, they're signaling a cutting cycle coming this September, even despite the fact that we're not in a recession by any technical indicator, right? At least not one that the Fed recognizes. And the Fed thinks that, the economy is doing great and everything's fine. So they don't have a justification really for lowering rates, except this massive elephant in the room, which is the debt spiral and the doom loop that's starting to ratchet onto the US Treasury, and it's starting to spin us out of control. And if this continues, right, this is an exponential process where we'll be getting, 1 trillion every 100 days, then 1 trillion every 50 days, then every 30 days, then every 10 days. And who's going to buy all that debt, right?
Mm.
How do you fund an exponential issuance of debt? You can't. You have to print it. So that's the slow rolling, like inevitable Thanos style, I am inevitable dollar endgame, part 2.
I love it. And you've really been beating this drum about how things will become exponential for many years now. I have as well, and people have called both of us crazy for years. But as you said, like $150 billion of debt was accumulated in 3 days. Things are going really exponential, and how quickly things are changing actually reminds me of a tweet that I saw of yours recently. So the tweet says, "Financial gravity. As we near the event horizon, all conventional economic models break down." Let's talk a little bit more about what financial gravity is and why it will break all of these economic models. So I wanted to quickly interrupt today's interview to let you know about the biggest mistake in the Bitcoin space, and that is this right here. So many people go out there and they buy themselves a great hardware wallet, but they make the terrible mistake of backing up their Bitcoin private keys on paper. And we know, guys, paper does not survive water. It does not survive floods. It does not survive fire. It does not survive ambitious children or dogs who might end up with your Bitcoin private keys in their mouth, okay? They might chew on paper. We know this, guys. So please, for the love of God, if you have spent the money on hardware wallet, go the extra mile and back up your Bitcoin C words on the generational storage solution that they should be stored on, which of course is titanium, which is why I'm so thrilled to be telling you guys about our flagship sponsor here on the channel, and that is Stampseed, okay? You can get yourself some Stampseed plates and you can punch your generational wealth into generational storage, and that is of course the titanium plates that you can get from Stampseed, okay? I'm thrilled to be able to give you guys a 15% discount on absolutely anything that you want to buy from Stampseed. So you can use a promo code Luke15 for that. And with all that said, let's get back into the show.
Great. Yeah, that's one of my most, famous pieces is Dollar Endgame Financial Gravity, one of the best chapters. Financial gravity is an analogy I use to describe, the issue of debt and over leveraging debt on an economy. So, central banks for years have thought that they could manage the business cycle, right? This idea first started in the 1970s when the Fed developed the dual mandate. Prior to the 1970s, the Fed actually didn't have a dual mandate. Their sole mandate was financial stability. But starting in the 70s, because of the inflationary crisis and, the Yom Kippur War and the the oil shock, all this stuff, there's public pressure on Congress to make the Fed adopt a dual mandate of inflation and unemployment. So the Fed did that. And then the Fed decided we're going to start managing the business cycle. So whenever we run into a recession, we'll lower rates to stimulate lending, stimulate credit growth, stimulate economic expansion. That will pull us out of the recession as we're going into it. And then as we get out of the recession and start to overheat and growth starts to go too high, we'll start hiking rates and slowing down the growth. And so their idea was taking the sine wave function of debt and credit cycles, which have existed for millennia, and flattening it to a straight flat line. So no more recessions and no more booms, right? That was their idea. So, that it works in theory. The problem is, if you actually continue to lower rates into a recession, you don't actually let the debt ever extinguish itself. So every time, if you can go back and look at a chart of FRED, of the effective Fed funds rate, and overlay that with recessions, you'll see that every time there's a recession, they drop interest rates down, they keep them there for a few years, and then they start hiking them. The problem is that the level they're able to hike it to the next time gets lower and lower. And that's the reason why that is because the debt level on the economy is growing and growing and growing. And so this cycle started in the 1980s with Paul Volcker. He brought the Fed funds rate to 18, 19%. in the summer of 1980 and kept it there through 81. Then we lowered it, and then we were able to hike it again to like 9. Then we lowered it and able to hike it to 5 pre 2008, and then we lowered it again, and we were able to hike it to a massive 2.5% before COVID. We lowered it, and then COVID hit, massive inflation happens, and we were able to hike to 5%, despite what many people thought. Didn't break the traditional economy, but it's breaking the treasury. Like I said earlier, it's causing an exponential debt spiral. So that debt is, you can think of it as mass, and it's creating this gravity that keeps sucking everything in. And every time that the central banks lower rates to zero, they're adding more debt to that black hole. And the black hole just gets bigger and bigger and bigger and stronger and stronger. And it limits their ability on the policy side to do any, any sort of intervention, right? Like exactly what we're seeing with Japan. Japan hikes by up to they hike their rates from 0% to 0.25%, and their entire economy blows up within 3 days. That's pretty incredible. Like, that doesn't happen if you're not trapped, and that's the problem, is that they are absolutely trapped. And so all these and so this financial gravity is warping the entire economy, warping everything, so that it's all a bubble, it's all financialized. Anytime they hike, anytime they try anything that's too restrictive on the money supply, it starts to contract everything immediately, very severely. And all these what I said there of all these traditional economic concepts break down is true, because again, like, you would think that if you raise rates into a, inflationary cycle, it would lower inflation. And at least in the short term, that's true. The problem is, like we said, with the treasury and the example of the US, if you raise rates and keep them there and let all the debt get refinanced at high rates, interest expense explodes. The banks can't handle all this new treasury issuance. So the Fed has to step in. The Fed monetizes it. All that money flows to the treasury. The treasury spends it in the real economy. Inflation comes back, and then their deficit goes up even more. And then they have to issue more debt. And you can see how this cycle just starts to very quickly run out of control. And what that means is that concept of raising rates into an inflation will slow inflation becomes flipped on its head. So I have a famous, tweet called the proving bull debt paradox. And I say in that tweet, right, like, ironically, the Fed doesn't understand that we're now in the end game, and the higher they hike, the further they'll move behind the curve. So the more they hike, the more eventual inflation they will cause. Not knowingly, but they will. And that means that all these models that they've developed, all these ideas of how things work, are going to get blown out of the water, because they think that raising rates will help the problem, it will hurt it. Lowering rates will help the problem, it will hurt it. Anything they do will make it worse. And staying here will just let the steady state climb of the US debt, grind higher anyways. So there's no real solution, right? They're trapped. They're already past the event horizon. And all these models that they have, all these Keynesian, brilliant geniuses at the Fed, don't realize, or maybe they're just, willfully ignorant of all the damage that this financial gravity is causing.
Again, I agree with all of that. I think all of the economic models are going to break. Now, maybe let's talk about how Bitcoin fits into this picture. There's a lot of Bitcoin models out there today. Do you think that this dollar endgame is going to actually impact how Bitcoin performs, and whether all of these models, like the power law model, for example, break in the Bitcoin space?
No, I think it absolutely will, right? Again, especially if we take the fact that Bitcoin could be a new world reserve currency, right? If Bitcoin becomes a global reserve currency, and other countries start printing their currency to buy it, or they start selling the US dollar assets as forex reserves and buy, Bitcoin with that, we're talking about, there's $7 trillion of just US treasuries alone held by foreign central banks, right? The global forex reserve market is, north of 15 trillion. This is massive buying power coming online. And that's not even to mention all the private and corporate interests that would have a desire to switch to Bitcoin as a settlement mechanism for international trade. That would cause the Bitcoin price to go up exponentially, because as we know, most Bitcoin is being held by long-term hodlers, I think over 75%. And then there's also a few million Bitcoin that are essentially lost forever, right? Either in cold wallets that people have lost the seed phrase to, or, Satoshi's initial basically 1 million Bitcoin. Those Bitcoins are essentially lost forever. So the real actual floating supply is much lower than people think. And if just a couple nation states get on this bandwagon and start draining the exchanges, I mean, you would see the Bitcoin price go up exponentially. I mean, there's no words to describe how quick it could happen. But the question is one of timing, right? That's the problem that all these models have gotten wrong. Plan B had that stock to flow model, which as of today, I think is predicting like 130,000 Bitcoin price. We're obviously, well below that, like 40% of that. So that was wrong. The power law, again, I think it can work, but it only will really start kicking in once we get into a hyperinflationary and or new global reserve currency style scenario. So those things, I think we're still waiting on them to happen, and the powers that be can drag this thing on for a while. But what Trump and RFK have said at the Bitcoin conference, I think was really encouraging. Right, if the U.S. adds a strategic Bitcoin reserve and then tries to hold that Bitcoin and use it to pay off the debt, right? Or maybe just switch to a Bitcoin standard, that could completely change the game, because as the dollar is the US reserve or the global reserve currency, them holding Bitcoin would put every other central bank on watch. They'll all be terrified now. We need to get our hands on some of this stuff, because if the big boys have it, if the Fed has it, if the Treasury has it, everybody should have it.
So I hope you enjoyed that little teaser for my discussion with Peruvian Bull. If you want to watch the full interview, that was actually posted literally minutes ago over on the bitcoinnews.com YouTube channel. I'm going to put a link to that video up on screen right about there. Again, I know a lot of you guys don't get notified when I drop the full interviews over on the bitcoinnews.com YouTube channel. So again, I hope this video helps you find it, and I hope you enjoy the rest of your weekend. Tune in tomorrow for another live stream, and I'll see you guys in the next one.